All right, let's dive right in. Today, we're going to trace the journey of a single click, like when you buy something online, all the way to how it becomes a number on a company's financial statement. We're going from click to cash.
I mean, think about it. We've all been there, right? You click that Buy Now button and, like magic, a package shows up a few days later. It feels so seamless, so simple. But what you just did was pull a lever that set off this incredible, complex chain reaction inside that company. From our perspective, the customer side, it looks pretty straightforward. We order, we pay, we got our stuff. But what we're seeing is just the very tip of the iceberg. Underneath the surface, a whole world of structured internal operations is kicking into high gear.
And that hidden engine, it actually has a name. It's called a business process. Now, this isn't just some boring corporate jargon, I promise. It is literally the blueprint, the hidden engine that powers pretty much every single company on Earth.
So what is it exactly? Well, a business process is basically just a recipe. It's a series of steps done in a specific order to achieve one particular goal. You know, whether that goal is fulfilling your order, hiring a new employee, or paying the bills, there's a recipe the company follows every single time to get it right.
And what's really cool is that you can break all these processes down into three main types. You've got your operating processes. That's the frontline stuff, the core business, like making things and selling them. Then you have the supporting processes, the essential back office functions like HR and accounting that keep the whole thing running smoothly. And watching over it all, that's the management processes, like setting budgets and planning strategy. Everything a company does fits into one of these buckets.
Okay, so we've established that a business is just a giant collection of all these processes and actions. But here's the million-dollar question. How do those actions become the cold, hard numbers we see on a financial statement? This is where we connect the dots.
And here it is. This is probably the single most important takeaway from our entire explainer today. Accounting data isn't just made up in some back room. It is born directly from these business processes. Every sale, every purchase, every single paycheck, each one creates a new data point for the accountants.
Let's make this super concrete. The moment your sales order is created, bam, the company can recognize that as revenue. When they send you an invoice, they create an entry called accounts receivable. That's just a fancy term for money we're owed. You pay the bill, their cash balance goes up. Finally, the invoice is settled, and that accounts receivable account gets closed out. You see? Every little step in the process triggers a very specific, very real accounting entry.
Now, you can imagine, with potentially millions of these transactions happening, how in the world does a company keep it all straight? You can't just use a notebook and pen, right? You need a pretty sophisticated machine to capture, organize, and just make sense of this constant flood of information.
Well, that machine is called an Accounting Information System, or AIS for short. This is the financial central nervous system for the whole company. It's the hub that connects all those individual business processes directly to the accounting records.
And an AI is not just a piece of software. That's a huge misconception. It's a complete system. It includes the people who use it, the strict procedures they follow, the raw data itself, the software, the computers and servers it runs on, and, this is absolutely critical, the internal controls that keep the whole thing secure and accurate. To manage all this complexity, accountants group related processes into these things called cycles. So all the recipes related to selling stuff are bundled into the revenue cycle. Everything about buying things goes into the expenditure cycle, and so on. It's really a brilliant way to organize what would otherwise be total chaos into logical, manageable buckets. So, we've seen how actions become data and how that data is managed. But why does this all matter so much? What's the real payoff for a business to get these processes right in the first place? Oh, the payoff is huge. Seriously, when your processes are well designed, you get consistency. That makes your financial reports way more accurate and makes audits go so much smoother. Good processes are also your #1 defense against fraud. But the ultimate goal, the real prize, is that clean, reliable data lets a company make smarter, data-driven decisions. But how do you guarantee that the data is reliable? How do you know you can trust it? The answer lies in something called internal controls. You can think of these as the safety mechanisms, the guardrails that are built directly into the processes themselves to ensure the data that comes out is trustworthy. And we're not talking about super complex stuff here. These controls are things like requiring a manager's approval for a large purchase. That's authorization. Or making sure the person who approves payments is not the same person who writes the checks. That's called segregation of duties.
It's these simple, powerful rules that protect the integrity of a company's entire financial story.
Because when you really think about it, a company's financial report isn't just a collection of numbers. It's the final chapter of a story. A story that begins with a simple action, is written through thousands of daily processes, and is proofread by internal controls. Every click, every hire, every sale, it's a sentence in that story. So the only question left is, what story are your processes telling?